Hey everyone, welcome to This Explainer. Today, we're putting SoftBank Group through a massive, fundamental reality check. We're talking about what's probably the most extreme experiment in modern capital allocation, hands down. We're going to look way past the flashy headlines and break this giant machine down just like senior analyst would to truly understand how it operates. Ready? Let's get into it.
Here's our roadmap for today. We'll be hitting the valuation mirage, the shift from telecom to tech, the vision fund machine, their bets on ARM and OpenAI, the NAV framework, and we'll wrap up with risks and failure modes.
So, part one, the valuation mirage. We're looking at the massive gap between paper wealth and actual reality. For years, SoftBank has basically acted like a magic machine that takes these wild, compelling stories of future tech dominance and turns them into present-day multi-billion-dollar marks on a balance sheet. It's a machine that creates enormous wealth, but also enormous illusion. Before we go any further, we literally have to define what this company actually is today. Forget the outdated labels. It's definitely not just a simple Japanese telecom operator anymore, and it's not a traditional venture capital firm either. What we are dealing with is a highly leveraged technology investment holding company. Its entire value is propped up on just a few crucial pillars: its anchor asset ARM, its massive new AI investments, the paper marks of the Vision Fund, its ability to actually exit those investments in the public markets, and, of course, the mastermind behind it all, founder Masayoshi-san. His aggressive risk appetite is the engine running the whole shebang.
And that brings us to the core tension of their entire strategy, the valuation mirage. What does that actually mean in plain English? Well, think of it like this. Imagine marking the value of your own house based on just one single record-breaking sale right next door. Boom! Your house looks incredibly valuable on paper, and your net worth shoots through the roof. But if you actually had to sell your house tomorrow to get the cash, the real price you'd get might be significantly lower. SoftBank essentially did this, but at a massive industrial scale in private markets. They used small, super high-priced financing rounds to mark up their massive stakes to astronomical levels.
All right, moving on to part two, telecom to tech. Let's trace the evolution of Masayoshi-san's empire.
If you zoom out, SoftBank's evolution is just staggering. They started with software distribution back in the 80s, caught the early internet wave with Yahoo Japan in the 90s, and then spent the 2000s building out highly predictable cash flows with Telecom. But right there in 2014, that's the absolute pivot point, the legendary Alibaba windfall. SoftBank's early bet on Alibaba turned into one of the greatest venture returns in history. We're talking about an extraordinary, once-in-a-lifetime outcome, and it proved to Masayoshi's son that a single, giant platform bet could completely transform the entire company. But here's the catch, and it's a dangerous one. That Alibaba miracle became the psychological template for absolutely everything that followed. It directly fueled the launch of the massive Vision Fund in 2017, and it's driving the huge AI pivot we're seeing pushing into 2026.
Which brings us to section 3, the Vision Fund machine. This is where capital literally became a weapon. This 2017 era was when SoftBank fundamentally broke and honestly completely redesigned the rules of growth investing. Look at this stark contrast between traditional venture capital and the Vision Fund style. Normally, traditional venture capital spreads out smaller, staged checks. They let the broader market organically discover the winners over time, which keeps valuation discipline at least somewhat tight. But SoftBank's Vision Fund, they completely inverted this. They walked in and deployed massive, upfront, sovereign-scale checks, literally billions of dollars. Instead of waiting for the market to figure out who the winner was, SoftBank just used their massive capital as a weapon to artificially crown the category leaders. By giving one single company an absolute war chest of cash, they forced all the competitors to respond. And what did that do? It made valuations jump incredibly sharply in the private markets, long before any real, rigorous public market discipline could even take a look. But as we all saw, that strategy had a fatal flaw. The whole illusion functioned in layers. First off, actual price discovery was completely distorted by those strategic private rounds we just talked about. Second, there was a massive mark-to-model liquidity gap. Essentially, just because a fancy spreadsheet says your stake is worth $20 billion absolutely does not mean you can go out and sell it for $20 billion in cash. And then we have step 3, which was the ultimate trap. We saw this spectacularly with WeWork. It's confusing subsidized scale with actual real growth. SoftBank's huge checks allowed companies to aggressively subsidize acquiring new customers. On the surface, that looks like explosive, hyper-growth tech adoption. But underneath, it's hiding incredibly weak, sometimes terrible unit economics. Okay, let's look at where we are today in Section 4, ARM, OpenAI, and AI. Welcome to the new technological cycle. So leaving the old Vision Fund era in the rearview mirror,
SoftBank's modern narrative has aggressively pivoted toward artificial intelligence. They are hunting for that next civilizational technology shift. But the absolutely crucial takeaway here is the striking contrast between the two main anchors of this new AI era for SoftBank. On one side, we have ARM. ARM is hard, observable reality. It's a rock-solid public anchor. We're talking real licensing revenue, sky-high margins, massive ecosystem power across smartphones and data centers, and an observable price that updates every single day in the market. But then, on the exact opposite side, we have OpenAI and Masayoshi Son's relentless pursuit of ASI, or artificial superintelligence. Now, these are massive future bets. They are heavily fueled by narrative capital. Look, AI is undoubtedly a real platform shift. No question. But these investments currently rely on unproven, future public market exits. As an analyst, you have to separate the sheer size of the dream from the cold, hard, probability-weighted value you can actually realize.
Let's dig into the numbers in Section 5, the NAV framework. How do we actually read these financial statements the right way? As fundamental analysts, if we truly want to understand what SoftBank is worth right now, we have to throw out simple metrics like standard PE ratios. We need to look at the actual math Wall Street uses. Check out this number, 30.93 trillion Japanese yen. That's roughly $200 billion US dollars, give or take. As of December 31, 2025, this was SoftBank's stated net asset value, or NAV. This right here serves as our absolute starting point. But hey, remember our earlier lesson about the valuation mirage? This NAV number isn't just cold hard cash. It includes liquid public assets like ARM, sure, but it also lumps in all those illiquid private models from the Vision Fund. So keep in mind, NAV is the start of the equation. It's definitely not the final answer.
Now, right next to that NAV figure is another absolutely critical percentage, 20.6%. That was SoftBank's loan-to-value ratio, or LTV, at that exact same December 2025 cutoff. Honestly, LTV is the master metric for SoftBank's literal survival. Because SoftBank's underlying assets can be so incredibly volatile, leverage is a very, very dangerous game. Keeping a controlled LTV like 20.6% is what dictates their flexibility when the market takes a severe dive. It gives them the breathing room to hold on to assets through tough times without being forced into a brutal fire sale.
So how do we find the true intrinsic value of the stock? Wall Street uses what's called a layered sum of the parts, or SOTP valuation. It's kind of like a giant puzzle. First, you start with ARM's current public market value. Easy enough. Next, you look at the Vision Fund holdings, but you have to apply a serious haircut, a big discount to those private fair value marks, because, well, who knows when or if they can actually exit those positions. Then you add in the AI bets, but strictly as probability-weighted options. After that, you subtract the company's debt. And finally, this is crucial, you have to slap on a holding company discount. This discount accounts for the structural complexity, potential tax leakage, and frankly, the capital allocation risk inherent in Masayoshi Son's sprawling empire.
Finally, we arrive at Section 6, Risks and Failure Modes. These are the shutoff warnings. To wrap up this briefing, we have to put our objective hats on and map out the systemic risks that could legitimately break the SoftBank machine. Pay super close attention to these shutoff warnings. These are the giant red flags that trigger the downside scenarios. Number 1, those private market marks could simply still be way too high, especially if IPO windows stay tightly closed. 2, ARM is a phenomenal asset, but if its public valuation multiple derates, SoftBank's overall NAV takes a massive direct hit. 3 and 4 go together. Liquidity mismatches and LTV leverage spikes. If debt spikes while asset values drop, SoftBank loses its margin of safety entirely. But you know what? Perhaps the most insidious risk of all is number 6, narrative addiction. This is the real danger zone, where telling grand, sweeping stories about civilizational tech shifts starts replacing rigorous, boring financial underwriting. It's the risk of constantly chasing the next dream before the last one has actually generated a dime of real cash.
Which leaves us with one final, totally pivotal question. When you boil it all down, the entire SoftBank debate rests on this. Is Masayoshi Son successfully building the ultimate, unassailable AI-era investment platform anchored by rock-solid assets like ARM and OpenAI, or is SoftBank simply recreating the exact same Vision Fund valuation mirage, just wrapping it up nicely in a shiny new technological story? The sheer size of the dream is undeniably massive. I mean, it's awe-inspiring. But at the end of the day, the ultimate test will be whether they can convert that grand narrative into cold, realizable cash. Thank you so much for joining me for this explainer.